In today's video, you will learn how to read candlesticks, along with bullish and bearish candlestick patterns that will help you throughout your trading. Let's get started. What is a candlestick? A candlestick is a way of displaying information about an asset's price movement, enabling traders to interpret price information quickly from just a few price bars. A few vocabularies that you will need to know about candlesticks are the body, which represents the open to closing range of the candles. And then you have the wick or shadow. It indicates the highest and lowest part of the candle within that session. The color, which reveals the direction of the market or equity movement, are as follows. A green or white body indicates a price increase, while a red or black body shows a price decrease. Now let's take a look at the anatomy of a bullish candle. With a bullish candle, the closing price is higher than the opening price. So let's take a look at the diagram below. The opening price of the candle starts right down here. As you can see, this is where price opened up at. So at some point throughout the day, price opened up over here, but there was a little bit of selling activity going on, which ended up pushing the price from the opening all the way down over here to a lower price point compared to the opening, which ended up forming this wick here. So at some point, the body of the candle was right over here due to a little bit of selling activity going on, right? But that selling activity did not maintain. As you could see, from this is the lowest point of the candle. This is where price was trading at for a moment, but the buying activity came back in, pushing the price from the lowest point, passing the opening price of the candle and pushing it all the way up here at the highest point of the candle. But that buying activity, that buying pressure did not maintain to where a little bit of selling activity came back into the market or within the session itself, pushing the price from the highest point all the way back here at the closing price action for this candle or for this session right over here. And as you can see, this is the formation of a bullish candle. The highest points where price was trading at one point when there was a lot of buying activity, and the lowest point was where price was trading at when there was a little or a lot of selling activity. But as you can see, what makes the candle itself bullish is the fact that the buying activity overall was more than the selling activity, causing price to push up above the opening, which, like I said before, the closing price, which is over here, the closing price is higher than the opening price. So this is your closing price and this is your opening price. As you could see, the closing price is much higher compared to the opening, and this is what makes it a bullish candle. Now let's take a look at the anatomy of a bearish candle. So with a bearish candle, the opening price is lower than the closing price. Let's go ahead and take a look at the diagram. As you can see, this is the opening price of the candle. This is where price opened up during the session of this candle right over here. So at some point, there was a little bit of buying activity that caused the price to momentarily be pushed up from the opening price to the highest point of the candle right over here. Now, the formation of this wick is due to the fact that the buying activity could not maintain, could not hold to the point where, the sellers came in and pushed the price from the highest point back to the opening, right? And from the opening passes the opening, right? Passes the opening price all the way to the lowest point of the candle over here. So this was a lot of selling pressure which came into the market to push it from the highest point past the opening price all the way over here at the lowest point of the candle. But that that major selling activity did not hold for long, to the point where a little bit of buying activity came back into the market, finally pushing price from the lowest point all the way over here at the closing of the candle. And this is where the price action for this session of the candle stopped. So the upper wick was formed from a little bit of buying activity coming into the market from the opening of the candle, right? Pushing the price point here, but obviously it could not hold. So the price was pushed all the way back down, and from there that upper wick was formed, and the lower wick was formed due to heavy selling activity not being able to maintain this area of the candle here, to where a little bit of buying activity came and pushed it back up, and therefore forming the lower part of the wick. And this is how this is what makes a bearish candle, because the opening price, right? The closing price is much lower than the opening price, because when selling activity comes in, it pushes price down. Now let's take a look at candle formations. Candles come in all different shapes and sizes. These sizes are determined based on buying and selling pressure or activities within the market. Based on the formation of the candles, it will tell you who is more in control. Is it the bulls, the buyers, or the bears, the sellers? The bodies of the candles and the wick itself will let you know who is more in control and where price action is being more favored to. Is it to the bulls or the bears? Let's take a look at this candle formation for the bulls. As you could see, the body of the candle is very small compared to the size of this wick right here. By looking at this candle here, it is saying that at some point there was a lot of buying activity that drove price from the opening, which is right here, the opening of the candle, and a lot of buying activity came into the market, which pushed price all the way to this point here. But as you could see, the body ended up closing here because at some point a lot of selling activity came into the market that pushed the candle that was once here, the body of the candle that was once here, all the way down over here to where it finally closed. So by looking at this candle, you could say that there is some buying activity, but overall there are more sellers than buyers, which drove the price action of the candle all the way from the top over here to close all the way at the bottom. Now let's take a look at this next one here. This one is a little bit more on the equal side. This is how you would read this candle here. At some point, price action opened up over here. Since this is a bullish candle, this is where price opened up. At some point, there was a lot of buying activity that pushed price from this opening all the way to this upper part of the wick. So this is where the buying activity came in. But as you can see, it did not maintain that price point to where sellers came in, pushed price all the way from the top here, all the way to the bottom. So this was major selling activity going on. But the sellers themselves could not overtake the bulls or the buyers, to where buying activity came back within the market, push price point all the way over here, slightly past the opening for the candle to close right over here. So by looking at this candle formation here along with the wick, it is telling you that the buying and the selling activity is pretty much equal. The bulls or the bears, the buyers and the sellers, that the activity going on both sides is pretty much equal, to where one cannot overtake the other. The same thing happened over here too, as you could see. But with this candle here is a little bit different in terms of price. Price of the candle opened up right here. Since it is a bullish candle, this was where the price of the candle, the price action started. And there was a little bit of buying activity that pushed the candle past the opening price, above the opening price, to this point of the candle. But you have to pay attention to this long wick. What this long wick is telling you is at some point, buying activity selling activity was so strong to where it pushed the price action all the way from this area all the way down over here. This is a lot of selling activity. So at some point you may have been looking at this candle formation while it was still active, because it hasn't been closed yet, and you would have looked at it, it would have been red because of the price being pushed all the way past the opening, all the way to this low point over here. At that point, you would say that, okay, the sellers are in control. But this did not hold for long. As you could tell by the formation of the wick and the candle itself, price action did get pushed all the way down here. But at some point, major buying activity came back into the market, which pushed price all the way past the opening to finally close right here. So by looking at this candle over here, you could say that buying activity is very strong, as opposed to this candle here where there was a little bit of buying activity, but it's not strong enough to maintain these areas to where selling pressure came, driving the price and the body of the candle to these areas here, as opposed to this, to where a lot of buying activity came into the market, pushed the candle from its lowest point, which was here, all the way to its highest point, finally closing here. And for this very last one, this is a very bullish indication. This is a very bullish indication of who is in control, which is the buyers. As you could see, it is a full-bodied candle with no wick. So what this means is that since this is a bullish candle, how you're going to read it is that price action, this is where the price action started. This is the opening of the candle. And at some point, a lot of buying activity came into the market, which pushed it all the way from this area where it opened up at to its highest point. And at no given point were there any selling activities. What would give you an indication of a selling activity is the wick itself. You would see that price is being fluctuated back and forth. But with this one, price was only going in one direction, which is up, which gives you the indication that there were buyers, and only buyers themselves are in control. Same thing goes for the bearish candle itself, to where price opened up in these areas, right? But there is a lot of selling activity going on, a lot of selling pressure that came into the market, which pushed price all the way to the lowest point, finally closing here. At no point within this candle formation was there any haggle between buyers and sellers. It was just buyers taking over, no buying pressure being able to take over the sellers. And the same thing goes for these candles also. As you could see, there was a lot of buying activity here once. There was once a lot of buying activity which pushed the price all the way to this upper part of the wick, but it could not maintain, to where the sellers came in, drove the price all the way back down. So the wick itself is representation of where price was once throughout this session of the candle, and the body shows you where price action decided to go towards, which was on the seller side. And the same goes over here. As you could see, this is basically a stalemate between buyers and sellers, to where one could not overtake the other. Same thing here with this type of candle formation. And over here with this candle formation, price actually opened up, I'm sorry, price opened up in these areas, right? Selling activity came in. Selling activities came in to push the price from the opening price up here. Selling activity came in, pushed the price all the way down over here. So at some point, it was mostly and only buyers, not buyers, but sellers who were in control. But at some point, the buying activity came in and pushed the price all the way from its lowest point of the candle all the way back up here. All the way back over here. But the selling activity came back to push it to finally close the candle here. So these are the different type of candle formation, and this is how you can look at them in order to determine who is more in control, the bulls or the bears. And with dojis, and we also have what is called a doji, which is basically where it is a stalemate. A doji is where opening price is the same as the closing. So this is another indication of where buying and selling activity is at a draw. The buyers could not overtake the sellers, and the sellers could not overtake the buyers. So it ended up in a stalemate to where the opening price is the same as the selling price. One candle formation by itself doesn't tell you much, but put a few of them together and you start to get different patterns. Over time, individual candlesticks form patterns that traders can use to recognize major support and resistance levels, along with reversals and continuation signals. Now let's take a look at 6 bullish candlestick patterns that can help you. Let's start off with the hammer. The hammer candlestick pattern is formed of a short body with a long lower wick, and it is found at the bottom of a downtrend. A hammer shows that although there were selling pressure during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than a red hammer. So looking at the diagram here, you can see that the overall trend of this price action is down. You have several candles depicting that. At some point over here, there was a little bit of a relief rally, but overall the sellers came back into the market. But looking at the hammer itself, you could tell by the elongated wick right here, this long wick, that at some point, selling pressure pushed price point all the way to this lower part of the wick, but it did not maintain because a lot of buying activity came back into the market, right? Came back into the market, pushed price all the way past the opening of the candle, right? Of the opening of the candle here, and push it all the way up here to finally close the candle. This itself, the hammer, is a very big indication that buying activity is coming back into the market and that this downtrend will soon reverse. As you can see, the next few candles that was formed after it were green, which is now pushing the price to the upside. Following the hammer, we have the inverse hammer. A similarly bullish pattern is the inverted hammer. The only difference being that the upper wick is longer while the lower wick is shorter. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. So taking a look at the diagram, right? We're still in a downtrend, right? Downtrend, slight relief. Sellers came back in from this little relief rally to continue pushing price down. But an inverse hammer throughout this whole downtrend was formed to where price action opened up right over here. Price action opened up right over here to the point where sellers came in. Well, not enough sellers came in to where it brought the opening price all the way over here. So at some point, this was a little reddish candle, but a lot of buying activity came back into the market that pushed the price past the lowest point of the wick all the way to the top here. But it is still a seller's market. The bears are still a little bit in control, which to the point where the buying activity and the bulls could not maintain this price point at the highest peak of the wick, to where it brought the price down to finally close here. But the good thing about the inverse hammer itself is that it's still a great indication of buying pressure slowly coming into the market. As you could see, buying pressure came here. Although it was not strong enough, it was still strong, and it was not strong enough to maintain this high point of the wick. It was still strong enough to close above the opening price, which indicates that a little bit of buying activity is slowly coming back into the market, not all at once, but slowly. But as you can see from the next few candles that are formed, they are bullish. So buying activity is slowly coming back into the market. That is the indication that an inverse hammer is giving you from a downtrend within a trading session. Next up, we have what we call a bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. So we're back on our downtrend. This is these formation of these bullish candles are being formed, from a downtrend. It is a point of reversal. As you can see, we're back with our downtrend. Slight relief rally over here, could not maintain. The bears came back, selling activity came back, push price a little bit further down, but at some point, the next candle formed was a very large green candle. So it's called a bullish engulfing because compared to the previous candle, which was red over here, which is still signaling that sellers are, there's still selling activities and that the bears are in control. The following candle is clearly suggesting that major buying activity is coming back into the market. As you could see, it completely overrides and engulfs the previous one, which shows that buying activity is greater than the little bit of selling activity going on. And as you could see from the next few candles, are bullish, indicating that this little run of the downtrend that the sellers are doing, that the bears are in control. Well, it came to a halting stop because the next candle was clearly bigger and had a bigger body than the previous one, signaling that buying activity is greater than the selling activity going on. So this is your bullish engulfing. This pattern itself is consisted of two candles instead of one. Next up, we have the piercing line. The piercing line is also a two-stick pattern made up of a long red candle followed by a long green candle. There is usually a significant gap between the first candlestick closing price and the green candlestick opening price. It indicates a strong buying pressure as the price is pushed up to or above the mid price of the previous candle. So let's go ahead and take a look at the diagram. As you can see, there are two candlesticks. The first one is a very strong bearish candlestick. This candlestick suggests that, okay, there are a lot of selling activities and the bears are in control, right? the strong red body of the first bar right here, this is what it suggests that the bears are in control. But the next formation, candle formation, after this candle here, after this bearish candle here, is a equally as big bullish candlestick, right? The close the next candle formation here is an equally as big bullish candlestick as compared to the prior one. So this one right here, if you look at the formation, study the formation of the candle itself, you would see that price, right? That price action actually opened up all the way down here, much lower than where it was closed off at the previous one. So if you're looking at the previous candle, this is where price action closed. But during the formation of the next price action within the next candle, this is where the opening price was, right? Much lower than the closing price, as you could see, right? There was a little bit of selling activity going on to the point where sellers came in, slightly push price down here, but it could not maintain that selling activity to where a lot of buying activity came into the market, which pushed price as far as down here all the way over here, overtaking more than half of the previous candle, right? But that price action could not maintain at the top to where a little bit of selling activity came back into the market, but it was not enough, it was not enough to where it actually closed. Price action of this candle here closed right here, above more than the midsection of this bar right here, which is what makes it a piercing line. Because as you could see, price itself shot up all the way from the lows here, all the way to the top, and closing off at more than half of the previous candle. That itself is a big suggestion. Well, not a suggestion, but indication of a lot of buying activity coming into the market. Now let's move on to the next one, which is the morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a 3-stick pattern, one short-bodied candle between a long red and a long green candle. It signals that the selling pressure is subsiding and a bull's market is on the horizon. So let's go ahead and look at the diagram formation. As always, we are in a downtrend. The selling activity there is a lot of selling activity going on, which is pushing price down. And again, we have a little bit of relief rally here, but obviously it wasn't enough because the next candle just went bloom and dropped price all the way right here. This is a lot of selling pressure, by the way. But the next candle formation, you could consider it to be a doji star, but not quite. But it shows you that there is some type of struggle going on between the buyers and the sellers. So let's take a look at it. As you could see, the upper wick is much longer than the lower wick, which suggests that price at some point was pushed all the way up here by the bulls, right? Because this is where the candle opened up. This is where price action opened up, right? Selling activity, major selling activity. Actually, at first, major buying activity came into the market, right? Which pushed the price of the candle up here, but it could not maintain, the bulls could not maintain that control to where the sellers came back in, pushed price all the way over here. But, there's a struggle going on to where the bulls came back, right? The buyers came back, buying activity came back into the market, pushed price from the slowest point all the way up here to finally close right here, right a little bit under the opening price. So as you can see, there was a little bit of struggle going on here to where the selling activity is not as strong. Because if you're looking at the previous candle, this is a lot of selling activity. But if you're looking at the next formation, right, of this candle here, you don't see any of the selling activity going on here. It's more of a struggle to where the bulls are coming back in and slowing down that selling activity to keep price afloat. And then from this next, after the formation of this next candle right here, you have this big long bullish candle, which suggests that buyers, right, the struggle that was going on here between the buyers in this candle formation here, between the buyers and the sellers, right, came to an end to where the buyers finally got control and pushed price, and started pushing price upwards, right, with this formation of this candlestick. The morning star itself it consists of 3 candle formations. So you have this major selling activity here, which is, the red candle, and you have a slight struggle between the buyers and the sellers forming in the next, and the other candle after that is clearly a bullish candle to where the bulls or the buyers came in and took over. Our next and final bullish candlestick pattern is the 3 white soldiers, or you could just call it the 3 green soldiers, since it's green. the 3 bars are green. So let's take a look at that. The 3 white soldier patterns or 3 green soldier patterns occurs over the span of 3 candles. As you can see, is the 1, 2, 3 candles right here. It consists of consecutive long green or white candles, depending on the type of colors that you're using for your candles, right? With small wicks which open and close progressively higher than the previous one. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. So let's go ahead and take a look at this diagram. Of course, we have our downtrend, taking price away from the market, right? But it slowly started slowing down with this first candle formation, which is not as big as the previous one, which is basically indicating that selling is not as strong as previously. And then with the 3 white soldier formation, right, you have 1, 2, and 3 consecutive green candles, and each of the candles is stronger and price is closing higher than the previous. So let's start with the first one. So this one right here, price opened up at this area and closed over here, correct? Right? So on the next one, price opened up slightly below the previous close of the candle, right? Slightly below, but buying activity is coming into the market, which pushed price all the way over here for that to close. So as you could see, as compared to the previous candle, price is closing much higher, right? The last time, the first candle, price closed over here. The second candle, price closed a little bit higher over here. And now look at the third candle. The third candle took that extra leap and decided to close all the way up here. Open over here, close up there. So like the definition says, it is a consecutive long green candles being formed with small wicks. The small wicks is basically representing that there is, the top of the small wicks for these 2 candles are basically indicating that there were selling activities. But by looking at the length of the wick, you could see that clearly it was not enough, to bring buying activity to stop or to halt buying activity. So this right here, the 3 white soldiers, is our last bullish candlestick pattern, and we will be moving on to 6 bearish candlestick patterns. Now on to our bearish candlestick patterns. The first one that we will be looking at is the hanging man. The hanging man is the bearish equivalent of a hammer. It has the same shape, but forms at the end of an up. It indicates that there was a significant sell-off during the day, but the buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. So let's go ahead and look at the diagram. As opposed to our downtrend for our bullish candlestick, as previously seen on the previous slides, for the bearish candle pattern, stick patterns, we will be looking at them from an uptrend perspective. So now here we have our uptrend, right? Steady, slow but steady overall. But at the very top of it, we have what is called the hanging man, right? As you could see, this right here is signaling that there is major selling activity coming into the market. So the way we could look at this is by the formation of the wick. Look how long the wick itself is. So reading this candle right here, we will know that price action opened up over here, right? And if you're really looking closely, you'll see this little small wick over here, which indicated that price was pushed up slightly, a little bit, like just a little bit above the opening, which, you know, the opening is here, and then, you know, it got pushed up slightly right over here. But clearly that wasn't enough, right? To the point where sellers came in and just dropped the whole price all the way down here. As you can see, price action opened up here, got pushed to the lowest point of the candle right down here. But considering the uptrend, there is still some buying activity in the market, which ended up pushing the price back all the way up here for the candle to close at this point. So although there was a lot of buying activity that caused price to be pushed back all the way up here, it's still not enough. The indication of this body, of this candle body here, is suggesting that there is selling activity slowly coming back into the market, because although price action for the bulls was strong enough to push it here, it was not strong enough to wipe it out completely, which suggests that there is, you know, there are some selling activities coming into the market from an uptrend, from a consistent uptrend. And as you can see, the next two previous candles, right, are bearish candles, which is now driving the price downwards. So look for a hanging man at the top of an uptrend, which suggests a reversal in trend from an uptrend to a downtrend. Next up, we have the shooting star. The shooting star is the same shape as the inverted hammer, but it is formed in an uptrend. It has a small lower body and a long upper wick. Usually the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground, hence shooting star. So let's look at the diagram. We have our uptrend, correct? We have our uptrend, and right here on our uptrend, we have our shooting star. So let's take a look at the candle formation for the shooting star. So looking at the shooting star, since this is a bearish candle, this is how we will read it. Price action opened up in this area, which is the upper body of this red candle, of this bearish candle here, right? So looking at the wick is telling you that at this point, price started off here at the open and the bulls came in, right? It was still a continuation of, you know, the uptrend, which caused the bulls and the buyers to come in and push price all the way up here, all the way in this area. That's a big jump right here. But clearly it was not enough. The buying activity was not enough to sustain, you know, this price action, to where sellers came in and pushed price all the way back down past the opening price, all the way down here at this very little point of this little wick right here. And although, you know, and right here this little wick is showing because a very slight slight buying activity came and slightly pushed it up to this area to where the body was completely formed, closing price action here, creating our shooting star or inverted hammer. You know, it has many different names, but you could, it's still an indication of the same, pattern reversal, not pattern, but trend reversal from an uptrend to a downtrend. So this massive selling pressure is suggesting that, okay, although we had an uptrend going on where the bulls, were dominating, right? At this very candle here, all of that changed to the point where a lot of selling activity came into the market, right? Pushing price all the way from what was once up here, which was once a very big green candle, right? A very bullish green candle. Sellers came in, pushed it all the way down here, closing price here. And as you could see with the previous two candles, the trend changed from an uptrend. Now it is going on a downtrend. Next up, we have our bearish engulfing. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red body candle. It signifies a peak or slowdown of a price movement and is a sign of an impending market downtrend. The lower the second candle goes, the more significant the trend is likely to be. So now let's take a look at our diagram. So starting off with our uptrend, right? As the definition says, our bearish engulfing consists of two candles. One that is, that is red, and the other one, not red, I'm sorry, which is green. Let me take that back. Our first one is green, right? Suggesting that, okay, the bulls are still in control, right? There's still major buying activity going on. But the next candle suggests that all that buying activity from the previous candle, right, basically got completely wiped out in terms of price action and momentum. If we're looking at the second candle, the red candle, compared to the first one, right, it has a bigger body. So let's take a closer look. Since this is a red candle, our price and opening price action starts off at the top here, right? To where at first this is where price opened up at, but there was still buying activity within the market itself, which pushed the price from this opening point all the way here at the very top, the very peak of the candlestick. But that buying activity, that buying pressure or volume did not last, as the sellers came in, and they came in heavy, which pushed the price point all the way from the peak here all the way down to this very bottom here. There was a little bit of buying activity, but it wasn't enough to push price back to these areas. And eventually the candle and the price action closed over here. Now, if you're looking at what makes this a bearish engulfing, is the fact that this entire body of the second candle, of this bearish candle, completely engulfed the buying activity and the buying pressure from the previous one, which is showing you a big shift between the buyers and the sellers themselves. And as you can see, this uptrend had a reverse, and now we're on to a downtrend. Now, onto our evening star. The evening star is a 3 candlestick pattern that is equivalent of the bullish morning star. So the bullish morning star, we saw that we were taking a look at the bullish morning star previously for the bullish candlestick patterns on our previous slides. And as you can see, the evening star itself is an equivalent to the bullish morning star. It is form of a short candle sandwiched between a long green candle and a large red candle. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erased the gains of the first candle. So let's take a look at our diagram. Of course, we have our uptrend, and here is the formation of the evening star itself. It consists of 3 different candles. So let's take a look at the first candle. The first candle is a very strong bullish candle, which signified that there is still a lot of buying activity going on. But if you look at the second one, right, it is very much different from the first. As you can see, it is giving you the appearance of a doji star, which is basically suggesting that there is some sort of power struggle going on between the buyers and the sellers. As you can see, it has a very tiny body, right? A tiny green body nonetheless, suggesting that, you know, the bulls are still, you know, a little bit in control. But if you're looking at the wick, it will tell you that there is a power struggle, because price opened up in these areas over here, right? The bulls came in, pushed price action all the way to the tip top here. But clearly that wasn't enough, because the sellers came in and drove price all the way down here, right? A lot of selling activity to wipe out, you know, to bring the price all the way down to these areas. But the bulls came back in, right? The buying activity came back in, pushed price slightly up. Well, not slightly, but a good amount, but not enough to fully or 100% take over in terms of, you know, the struggle between between buying and selling activity. You know, there's slightly, you could look at this as being how do you say it? Let's put it as 55% in terms of, you know, of buying activity going on, and the other one is 40. I'm sorry, I'm doing bad math. 45% in terms of selling activity. So it is pretty much equal, not equal, but, you know, it's pretty much on par with each other. So right here, this is what this candle right here is telling you. And then the third candle formation is a very big or large, you know, a large bearish candle, to the point where this is where the price action started, right? The price action started right up here, but a lot of buying pressure came in, right? Came in to the market, pushing price all the way down here, right? At some point, this entire candle itself at some point was engulfing all of the gains that was, you know, added by the bulls on this candle here, right? Like the definition says, it indicates the reversal of an uptrend, and it is particularly strong when the third candlestick erased the gains of the first candlestick. And this is what I was trying to show you in terms of the price action got pushed all the way down here to the point where at some point this entire candle erased all the gains that was done, you know, that was built up by the buyers on the first candle. So this is suggesting that heavy selling activity is coming into the market. And with the formation of these 3 candles, this is how it shows you the switch between the buyers and from the buyers to the sellers. And as you could see, with the next candle being formed is another bearish candle, right? Switching from an uptrend going into a downtrend. And now we have our 3 black crows. For the bullish side, for the bullish side of the candlestick patterns, we had what we call the 3 white soldiers or 3 green soldiers, however you want to pronounce it. But with this one, for our bearish, for this bearish candle stick pattern, we have what is called the 3 black crows. So the 3 black crows candlestick pattern comprises of 3 consecutive long red candles with short or non-existing wicks. Each candle opens at a similar price to the previous day, but selling pressure pushed the price lower and lower with each close, right? So let's take a look at the diagram. Actually, let's take a look at this here first. Traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers during the 3 consecutive candles. Okay, so now let's take a look at the diagram. We have our uptrend, of course, right? But you know, there's a slight pause here. As you could see, with the first candle being formed in the 3 black crows, right? It is a red candle, where price, it's a red bearish candle where price started here, right? And got pushed up all the way over here, all the way down here. But there was a little buying activity still in the market, which, you know, pushed it, you know, from, you know, its lowest point here, pushed it back over here for, you know, the candle to finally close at this price point. Overall, you know, still a significant, you know, selling activity compared to the little bit of, you know, buying activity that tried to push the price up. And then the next candle is a very, you know, a bigger one, actually, a bigger red bearish candlestick, which suggests that, you know, the selling pressure is still coming in, and it's still coming in strong. Opening of the candle is here, right? Price selling activity came into the market, driving price all the way down here to the lowest point, right? But there was still a little bit of buying activity going on, as you can see. But, you know, it's still not a lot, you know, it's still not a lot compared to all of these sellers. This is a very small buying activity, which, like the definition says, right? Long candles, right? Long red candles with short or non-existing wicks. As you can see, these wicks right here are pretty, you know, they're short. They're pretty near non-existence, but they're still there. And then with the third candlestick, you know, just as big, actually probably bigger than the previous ones, right? Price action started over here, but, you know, the bulls, the buyers, try to come in and to push price point at this very tip of the wick here, but clearly it could not hold to the point where the selling activity came in heavy, pushing price point all the way from this very top here, right, to finally close all the way down here. And this is what makes your 3 black crow pattern. And as you can see, the next few candlesticks, right, you can even take a look at that one, to where buying activity could not maintain, right? There was, you know, a good amount of buying activity where it opened up here, price gap got pushed up all the way at this very end, but buying activity just came in, pushed it all the way back here for it to close. And then the next candle, you know, surely was another red candle, which suggests that the overall trend has 100% shift from an uptrend to a downtrend because of the 3 black crows. Now, for our next and last bearish candlestick pattern, right, we have what is called a dark cloud cover. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day optimism. It comprises of 2 candlesticks, a red candlestick which opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candlesticks are short, it suggests that the downtrend is extremely decisive. So now let's take a look at the diagram. No more uptrend, but overall here, the dark cloud cover is a formation of 3 candlesticks. So let's take a look at the first one. So our first candlestick compromises of a very steady and strong bullish candle. As you could see, if we're reading the candlestick, as you could see, this is the opening of the price, right? This is the opening of the price. At some point, the sellers came in and pushed price all the way to its lows right over here. But major buying activity came into the market, pushing it from its lowest point, right? Pushing it all the way up past the opening price, right? All the way up here, which is the highest point of the candlestick. But finally, a little bit of selling activity came back into the market, pushing price action from its highest point to the closing price right a little bit up here. Overall, this is a very strong bullish candlestick, right? This is a very bullish candlestick, which if you're seeing by itself, you will say, okay, the bears are in control, the buyers are in control. But if you're paying attention to the second one, as you could see, this thing is massive. If you were to probably put it side by side, it engulfs this entire thing. Or is it? Yeah, it engulfs this entire thing pretty much. And let's take a look at it. This is the opening price, right? And this is the closing price of the candle, right? So it is very big in terms of it covering this entirety of the first candle. But what's the important part of the dark cloud cover is the confirmation, is the third candle. It's the third candle that is formed after these two previous ones. As you can see, this third candle that was formed, there isn't any significant buying activity going on as compared to the first one, right? So with the first one, we have major buying activity. But with the second one, we have major selling activity that overrides the first buying activity that was going on, because clearly the second candle is much larger than the first, which indicates more selling activity than buying. But with the formation of the third candle, there is significantly less buying activity compared to the first candle due to major sellers and major selling activities coming into the market on the second candle right over here. So it is not enough. It is not enough. There isn't enough buyers to push price, to the point where it could override this entire selling activity. So as you could see, this third candle here is giving you confirmation that the bulls or the buyers have the weak hand. They are weakening. As you could see with this candle formation, it is not as big as the previous first one, right? And this would be your confirmation telling you that this whole entire pattern, three-stick pattern itself, is a dark cloud cover, because the first one, not the first one, but the second candle is overriding the entirety of these buying activity, right? And then the third candle is not strong enough to overtake all the selling activity that is going on within the second candle before it. Next up, we will be looking at 4 continuation candlestick patterns. These patterns suggest a continuation in a current trend, whether it be an uptrend or a downtrend. For our first continuation pattern candlestick, we will be looking at the doji. The doji is formed when a market's open price and close price are almost at the same price point. The candlestick resembles a cross or a plus sign. Traders should look out for a short to non-existing body with wicks of varying length sizes, right? So this doji's pattern conveys a struggle between buyers and sellers that results in no net gain for either side. Alone, a doji is a neutral signal, but it can be found in reversal patterns such as the bullish morning star and the bearish morning star. So let's take a closer look at the doji. So as I mentioned before in the previous slide, a doji is pretty much a power struggle candlestick depicting a power struggle between buyers and sellers. So doji where buyers and sellers are pretty much equal would look more like a plus sign or something like this, where one is slightly taking it slightly has the upper hand above the other, but not enough for it to make a big significant difference. And like the definition says, you mostly find dojis in reversal patterns or along with other bullish or bearish indicators such as the bullish morning star or the bearish evening star. Now let's move on to the next one. So the next one, we have a spinning top. The spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher while the bears push it lower again. Spinning tops are often interpreted as a period of consolidation or rest following a significant uptrend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. So looking at the spinning top, it is similar to the doji, but the only difference is the very elongated wicks. As you can see, they have pretty, big wicks. Spinning tops themselves could be found within uptrends or downtrend. So within a downtrend, a spinning top, such as this green one here, would indicate that there is a change coming in terms of trend reversal. So on a downtrend, a green spinning top will signify that the trend will be changing from a downtrend to a possible uptrend with enough momentum. And same thing goes for a red spinning top within an uptrend. It will signify that the uptrend will soon end and that a new trend will start, which is a downtrend with enough momentum, of course. Next up, we have the falling three method. Three method forming patterns are used to predict the continuation of a current trend, be it bearish or bullish. The bearish pattern is called the falling three method. It is formed of a long red body followed by three small green bodies and another red body. The green candles are all contained within the range of the bearish bodies. It shows traders that the bulls do not have enough strength to reverse the trend. So looking at the falling three method as depicted in the description, right? We have two red candles, right? And in between those two red candles, we have three green candles. And these green candles, like suggested, are trading in between the range of the first red candle and the last red candle. So there isn't any significant, movement between the current prices of the first candle and the last. So they're trading right in between those price ranges, right? To the point where the pressure, because if you're looking at the first candle, it suggests that there is a lot of major buying activity going on, within one single candle or one single drop, as opposed to, these three bullish candles, right? Suggesting that there is a little bit of buying pressure, but it is slowly building up. As you can see, it built up a little bit here, built up a little bit here again, and built up a little bit here again, just for the sellers to come back with even more selling activity, even more pressure to bring the price lower than it previously did on the first red candle. Next up, we have the rising three method pattern. The opposite is true for the bullish pattern called the rising three method candlestick pattern. It comprises of three short reds sandwiched within the range of two long greens. The pattern shows traders that despite some selling pressure, buyers are retaining control of the market. So looking forward at the rising three method compared to the falling three method, right? It is basically the opposite. So with the rising 3 method, you have two strong bullish candles, suggesting that, you know, the buyers are in control. With the first one, it is a very strong singular bullish candle, and then with the 3 red candles, bearish candles in between, they are showing that there are little selling activity going on. As you could see, each candle is, you know, is trading. All 3 candles are trading in between the price range of the 2 green bullish candles. It's not anything significant that would take the buyers out of commission or out of control. As you could see, after this little bit of selling activity going on, the buyers came right back to push the price upwards. So this is the rising 3 method. It is similar, well, not similar, but it is the opposite of the falling 3 method. Thank you for watching. I hope you enjoyed and learned a lot from the video. Go ahead and smash that like and subscription button, and follow us on social media for more content. And stay tuned for the next video.